The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The Fed goes quiet and markets go ape. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. You wanted fireworks.
Well,
we got fireworks.
We got them. We certainly did.
We did. All right, let's take a look, just broad base at where we are across asset. If you want safe haven and you want a flight out of risk, this is the board you're looking at. S&P around the lows of the session. Tech getting hit the hardest. Money flowing into the bond market, particularly in that front end as that curve continues to disinvert. We're now 5 basis point spread. Just how quickly that re-rated says a lot about where we think the Fed is headed. Dollar weaker, yen bid, and crude also off. All risk off. Running into safety, Romaine.
Yeah, an incredible day here and an incredible week, and it's really hard to pin the massive market moves that we've been seeing on any one thing in particular. Rather, it's really that amalgamation of concerns about high valuations, AI skepticism, cracks in the consumer, and now an in-line jobs report that actually had some out-of-line backdated revisions that signaled that the labor market, while stable, is still signaling a cooling in economic activity. It's a cooling in economic activity that Fed Governor Waller says needs immediate attention.
I believe that the balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
New York Fed President John Williams today also saying it's appropriate to start cutting rates, and Chicago Fed President Austin Goolsbee telling CNBC that if the Fed doesn't move soon, recession risk will rise. And that's all, folks, from Fed speakers as they enter that so-called media blackout period ahead of their next 2-day policy meeting. That starts September 17th, and that leaves stocks and bonds to their own devices for the next 7 trading days. And if those days are anything like the past 4 sessions, hold on to your hats. And S&P a stone's throw right now from retesting that 100-day moving average. The NASDAQ 100 a brick's throw away from its 200-day. And chip stocks right now set to log, Alex, their worst weekly performance going all the way back to March of 2020.
Really, really brutal out there. Let's look at this yet a different way. And this just takes a look at the weekly decline for the S&P. And we haven't seen this kind of week since all the way back in March of 2022. You can see the sort of speed of re-rating that we're seeing so far for this week. And as Romaine was just saying, there's so many other superlatives, right? The NASDAQ 100, worst week since November of 2022. Then you got the 2-year yield moving as much as 27 basis points to the downside this week. And the semis getting hit really hard. NVIDIA right around that $100 a share level. Romaine, any superlative you want to use, and it's really ugly out there in the equity market.
Absolutely here. I mean, that is the setup, of course, heading into next week. And I guess in about a week and a half's time, that big Fed meeting. Julia Coronado joining us right now to kick us off to the close. She's president and founder at Macropolicy Perspectives, and in a past life actually worked for the Federal Reserve Board out there in Washington. And Julia, let's start off with the jobs report that we got this morning. I mean, on the surface, it wasn't awful, but obviously you have a market that's really been on edge trying to figure out what the Fed is going to do. And I do wonder what today's report signaled most to you.
Well, again, the question that we were all waiting for clarification on was to what degree was the weak July report a reflection of noise and storm effects, and how much of it was signal. And unfortunately, most of it turns out to be signal. The pace of hiring is slowing. The unemployment rate, while it ticked down on a rounded basis, it barely budged on an unrounded basis. And basically, it's risen quite quickly this year. And it looks to be that we're in a cooling job market. The Fed needs to, take action to address that. There's no real engine of growth that we see across sectors in terms of hiring. And in fact, what we're seeing is sectors like healthcare and state and local governments that really held up the job market and provided a lot of resilience are starting to cool off. Again, nothing outright disastrous in this report, but you don't want to wait till you see disastrous to remove some of that policy restriction. So I think it's a clear green light for the Fed. The question is now 25 versus 50. To start with, Waller seemed to suggest they might want to lean towards 25. But ultimately, they're going to have to be very responsive to the data in coming months.
Well, as part of that data that we got today, Julia, there was also, I guess, that slight uptick that we saw in hourly earnings. Should we just dismiss that? How does that factor into the decision making?
Yeah, I think wage growth has moved into a range across indicators, including average hourly earnings. It's pretty consistent with the Fed's 2% target. When we economists think of wage growth, we take productivity, which has been running pretty strong, and add on the 2% target for the Fed. And that puts us in the 3.5% to 4% range for sort of equilibrium, non-inflationary wage growth. And that's exactly where we are. So we're out of the world where every sort of slight nudge of wage growth is being interpreted as an inflationary signal. It does not look like the labor market is generating sustained inflationary pressures.
So based on that, Julia, this is like a really measured take of the jobs report. And I'm just wondering, why then the intensity in the equity sell-off? Like, what is the equity market forecasting that are not yet reflected in the current backward-looking numbers?
Yeah, that's a great question, Alex. I think some of it gets to valuations. You know, we had the chip stocks and the Magnificent Seven really, valued to perfection. So now that there's more risks on the horizon, there's some reevaluation of that. And I think there's some global nervousness around the fact that we've really come to rely on the U.S. as the engine of global growth. And to the extent that that is sputtering a little bit, again, nothing looks outright disastrous, but if we're relying on the U.S. as the engine, that engine is losing some steam. So there might be some nervousness around that as well.
Okay, so let's just game it out. We do 25 in September, and then there's a continuing cycle after that. The market's still pricing in about 240 basis points of cuts through the end of next year. Is that an economy that needs that many cuts?
Yeah, I think we have to remember that we're in an unusual cycle, and that the Fed went roaring upwards. They were sort of late to the party when inflation took off. They caught up with these gigantic rate hikes. We're at a level that pretty much everybody would agree is in restrictive territory, certainly everybody on the FOMC. And so what we're doing here is just kind of trying to move to a more neutral setting, which is a good 150 basis points from where we are. So that move towards a more neutral stance, we're at 5.5. The Fed cutting 150, 200 basis points just takes us to 3.5 to 4, which is still a pretty high rate relative to prior cycles. So it's an unusual cycle in that regard. And that's assuming the Fed has the luxury that they're not late to this party and that they don't have to play catch up with some, faster cuts to the downside, because maybe, the worry here again amongst economists is once the labor market starts slipping, it tends to keep slipping unless there's some really notable policy catalyst. So does the Fed have the luxury to move gradually is an open question, and we just don't know yet.
Well, for those of us who don't have, PhDs in economics, Julia, how fast can that happen? How fast can the economy turn?
Well, it can turn very fast. So when we point to things like, retail sales are holding up. Well, yeah, retail sales tend to hold up until people get real worried about their jobs. So right now we have that feedback loop between jobs and income growth and spending. It's still intact. There's still time for this soft landing to play out. But, once you've lost that, once companies give up the labor hoarding and turn to job cuts to maintain and protect margins, then you're in a self-reinforcing dynamic to the downside. And that is what we are trying to avoid, what the Fed wants to avoid. It still does look like they have some time. But yeah, this data, I think Alex called it backward looking. It is backward looking. We need to be forward looking. Mm-hmm. And what we're seeing in earnings reports, it's kind of, you can look at it glass half full, glass half empty. There really isn't a lot of strong hiring intentions that we're hearing in earnings reports, but there also aren't big layoff plans. So right now it's kind of like a grinding to a halt in the labor market rather than falling off a cliff. But that's not great news because that makes us much more vulnerable to adverse events.
All right, Julia, always wonderful insights. Julia Coronado, president and founder at Macropolicy Perspectives. As we kick you off to the close with a closer look at the market reaction today, and tech is really feeling it. Right now, you're looking at a NASDAQ down 11% from those July highs, Mag 7 down 15%, the SOX down 23. A conversation up ahead with Sarah Kunst, managing director over at CLEO Capital.
All right, plus Intel thinking of dumping part of its Mobileye stake as a way to ease its financial woes, what it means already for the struggling struggling driverless tech company.
And with a focus on tech, maybe we should focus on Apple. Can they save the day? Apple planning to launch its brand new iPhone, AI-capable iPhones on Monday at its Glow Time event. We're going to break down just how high the stakes have gotten. This is The Close on Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Tech hit hard today. The Nasdaq 100 just basically around its session lows. Nvidia off by 3.7%, just wiping out more than $400 billion in value just this week. Joining us now to discuss the current tech trade is Sarah Kunst, Managing Director at CLEO Capital. Hey, Sarah, what do you do with tech right now? Like, where's the bottom here, and what's that catalyst?
I think you cry a little bit. It has not been a good day, but the reality is I think the catalyst is all of it. I mean, these are names that have been going up and up and up. And when you look at those multiples, when you look at where they trade versus their revenue versus the rest of the street, it doesn't make a ton of sense. And so I'm not shocked to see the air come out of some of these tires, even though they're coming out for different reasons. Some of them have regulatory issues. Some of them are having problems with sales. But I think that this is a long-awaited and kind of much-needed correction.
So do you buy the dip yet? And if not, when and where?
I mean, that's the hard part. This isn't really a dip. When you look at the actual prices versus revenue, these are still a lot of really, really, really expensive names. It is hard to look at a Tesla right now and say, hey, this is a good deal. I do think that there are probably some knock-on effects, some sort of bystanders who are going to get caught up in this that might be good deals. So when I look at AI names, I like NVIDIA, but it is really expensive. I tend to gravitate more towards the Taiwan semiconductors of the world, and I think that they haven't gone up as much. And so as they feel some of that downward pressure, maybe they become a buy. But when you look at the fundamentals of these tech names, they are still priced like massive growth stocks. Most of them are still up on the 6 month and certainly up on the year. So the reality is it's not quite the correction it feels like it is today.
Yeah, absolutely. I mean, you're seeing a little bit more activity, I guess, when it comes to some of those second tier type of names. I do want to get your thoughts here, Sarah, on this Apple event that's supposed to unfold next week. We get this new lineup of iPhones, the software updates that include these AI features to come later. But is this possible that this could be a catalyst, at least on the consumer-facing side of AI, more of a catalyst for adoption of AI?
I don't think that this is going to be a phone that massively changes how consumers feel about AI, in part because Apple's been doing AI in their phones for a very long time, right? We might get frustrated with Siri, but that is most certainly AI that has been in your phone for years and years and years now. When you look at your albums and all of a sudden your photos are just perfectly stacked to show you, all of your friends that you haven't seen in a while, that's AI. So the reality is Apple's sort of the victim of its own success, and I've been saying this, in that they already have an AI phone. Now they just need to get credit from the street for it, and that's kind of the catch-up they're playing.
What do you think the street's looking for, at least when we're talking about these public tech companies? I'm talking the larger ones, the Apples and NVIDIAs of the world here. I mean, beyond just this phenomenal, X 100% growth that they've been getting out of some of the chip makers, what do they really want to see?
I think what they want to see in a lot of these names that are tied to AI, which is most of these big growth ones, they want to see actual revenue coming from AI. And so you see that a little bit with NVIDIA, a little bit with sort of the chip, designers and fabricators. But the reality is that when you look kind of downstream, you're not getting on earnings calls and hearing that, Meta or Google or any of these names are making a ton of money from having AI capabilities. And I think that's really the tipping point people are waiting for.
I mean, yet. So what's going to happen first? They start to deliver the money or they pare back their spending? Like, no one wants to be the first hyperscaler that pares that back.
Well, and that's the hard part. They have to spend so much. Every time you hit a query on an OpenAI, right, on a chat GPT, that is costing somebody more money than you would think. And so that's a hard balance for them. They need to figure out where they monetize it. Google's certainly trying to do that. It tells you, hey, upgrade to Gemini, Plus or Gemini Advanced. It's $20. You get some extra cloud storage too. So you do see some of those names who are trying to make that happen. But I just don't think we're there yet in sort of a day in, day out way with consumers or even enterprise that is really going to make it happen in the next 6 months to a year. And the other thing is, all of these tech companies are developing this stuff at the same time. So if you use Gemini, you use Meta's AI product baked into their apps, you use ChatGPT, they all work and they all work pretty well. So why would you pay one when you can kind of get them all for free? And as we know, when companies have to compete, good for consumers because it drives down prices, but it is probably really bad if you're listening right now.
Sarah, great conversation. Have a wonderful weekend. We're going to catch up with you again really soon. Sarah Kunst, Managing Director over at CLEO Capital, with a focus on tech here as we kick you off to the close, and a focus on Mobileye, the autonomous driving company, seeing its shares down at its lowest levels as a public company. It's part of our top calls. Stick with us. This is The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, big movers on the back of analyst recommendations. And we start off today with Expedia Group. Truist Securities starting new coverage of the travel booking platform with a hold, citing signs that leisure travel growth is moderating. The analyst also sees Expedia and its peers exposed to demand shock risk, inroads by other tech companies, and competitive threats from travel suppliers. Those shares down 2% on the day. Next up, Robinhood actually getting a lift today to equal weight from underweight. This over at Barclays. While the analyst sees near to medium term risk, he says the trading platform has benefited from improving retail trading conditions and a, quote, recovery in crypto markets. Those shares, though, down about 3.5%. And finally, we got to take a look at Supermicro, hit with another downgrade this week. Today's call coming from JP Morgan, which cut its recommendation to neutral. Supermicro, of course, delayed that 10K filing, and the analyst says investors should remain on the sidelines until the company is back in regulatory compliance. Those shares down about 6% here on the day, and those are some of our top calls. We do want to say in the world of tech and revisit that story that Alex was alluding to earlier. Intel, Mobileye, shares of Mobileye right now plummeting to a record low. This is Intel, its largest stakeholder, weighing selling part of its holdings on public. Intel is basically going to consider selling off about 88% of its stake in the public market or to a third party, and that's causing a little bit of concern here for investors. Miscioscia joining us right now, senior technology analyst over at Daiwa Capital Markets. He's got a neutral rating on Mobileye. Louis, kind of first put this in context for us. This seems like a pretty severe market reaction. Just kind of explain why.
Well, for one, you've got obviously a down day in tech, which doesn't help. But the issue with Mobileye is that it just wasn't one disappointment. They actually have had, I guess you could count three. The first one was January of 2023. I could explain that if you want to go into detail. Then January of 2024, and then when they reported last quarter. So the shares have really been hit hard over the last, let's say year and a half, 2 years. And now Intel's considering selling a bigger stake, possibly to investors. So, they're already worried about being diluted, and this would be an issue of possibly being diluted even more. So I think that's the concern that's hitting it, besides obviously these other issues that have happened over the last couple of years.
Well, that's what I'm going to get to the other issues. Okay, so you have the dilution aspect, more of a technical aspect in the market. So that's understandable. Talk to me about the fundamentals of this company, because when I think Mobileye, I think about kind of the future of whether it's autonomous driving or some of the other technology that we've been obsessing over for the last couple of years. And I don't understand why they're not benefiting more from that.
Sure. Well, there's the long term, probably something that's going to happen, let's say in 2026 and beyond, and then more the near term. In the near term, the biggest issues from them is one of their biggest customers is Geely in China, and especially EVs. So when you go back to January of 2023, that's when they start to see weakness in EVs in China. That hurt them then. Then when they got to January of 2024, it was just too much inventory at the auto companies. And then the most recent quarter in June that was reported in July, it was back to China, being that China wants to sell, and Geely wants to sell some of their EVs to Europe. Europe is resisting, as the U.S. is, with restrictions on that. Obviously, EVs have been weak. And then some of their big customers that then sell U.S. and European into China now have also been slow. So it's really just a big slowdown in demand, mostly in EVs, which when you look at ICE cars, internal combustion versus EVs, most of the EVs are the ones that have more self-driving features at this point. The real ramp in more self-driving features is expected to come from all the different names in 2026. So we're still pretty far away from that.
Well, okay, so is the structural case for like a Mobileye still intact, but maybe it's pushed out a little bit, and this is just like a deep cyclical cycle? As you know, in Wall Street timeframes, if you're pushed out a year and you've already had a bunch of disappointments, there's just a lot of concern that starts to rise. So, maybe in the back half of next year, 2025, we could start to think more positively about what could happen in 2026. But self-driving has been something that's been fraught with technical delays, as we've seen with all the vendors throughout the country, whether it's San Francisco or other cities. So it's been something that's been much more difficult to get to work. Thus the concern and the doubt by many investors. Louis, are there other competitors to Mobileye that's a pure play, or are other guys kind of building it in-house so it's a little bit more isolated? Yeah,
well, Mobileye is the only name that I follow. It's a pure play. However, Qualcomm has a very strong auto business that they've been doing quite well in. NVIDIA is also in that market. Obviously, NVIDIA's business is materially focused on data center now, so their auto is tiny in comparison, maybe 1 or 2% of revenue. But they are also one of the competitors. So those are the big ones that we also track that are in the space, besides obviously the whole auto industry that's doing different things in that space, but from our semiconductor coverage.
All right. Thanks a lot, Louis. Really appreciate it, Louis. Miscioscia joining us over at Daiwa Capital Markets. But man, I mean, whether you look at it as a Mobileye problem or an Intel-specific issue or a structural or cyclical, it's like all bad. Yeah, all bad. And it comes, of course, on a week when everybody, I think, is really starting to reevaluate that tech trade. And then you kind of wonder where Intel fits into all this, where Mobileye fits in all this. Is this really that specific to them, or is this something broader? And it's interesting. I feel like for so long I've been trying to figure out what a cycle looks like when it comes to AI. And is this part of it, or is this like a normal blip when it comes to the equity market, or is this like the start of the cycle and it's like, okay, now we have the downturn, now we come up, and how long that lasts? Yeah, good point. All right, well, how aggressive will the Fed rate cuts be? That is the question. Is it 25 or 50, and what does that tell us about the economy? No person better to talk to than Bill Dudley, Bloomberg Opinion columnist and former New York Fed president. We're going to break that down with him next. This is The Close on Bloomberg.
With the economy now in equipoise and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate.
New York Fed President John Williams talking about those imminent rate cuts. And I think we can say that now, Alex. 3:30 p.m. here in New York. This is the countdown to the close. That's Alex Steele. I'm Romaine Boston. Yeah, and my question really then becomes, when he said things like, if appropriate, we could front load. Yeah. Is he setting the stage for 50, or is he tempering it by saying, if, guys, we're not there? Yeah, I mean, that's the parlor game right now. But we also heard from other Fed members, right? And I know maybe they're not talking 50, but this idea here that this sense of urgency, that something needs to be done, and maybe that means that they have to do something big, not just say a 25-point incremental move. Right, or does that freak out the market more? Where city traders are actually betting on half-point interest rate cuts from the Federal Reserve this year, multiple ones. They say the Fed will ease policy aggressively if it sees a soft labor market, a wager that outpaces both the market and the view of the bank's economists. Well, joining us now with his thoughts on this, Bill Dudley, Bloomberg Opinion columnist and former New York Fed president. Here's my unfair question. You looked at the data, 25 or 50 in September?
Well, I think the logic for 50 is pretty compelling. The Fed officials have basically said policy should be neutral. The risks to the labor market side are equal to the risks on the inflation side, and they're a long way from neutral. But I don't think they're going to do 50. I think that a gradual approach is what they're going to pursue. Today, you had two Fed speakers, John Williams and Chris Waller, and neither of them, hinted that they might go more aggressively at this meeting. So I think the logic for 50 is pretty strong, but I think they're just going to do a 25 basis point rate cut in September.
If they don't do 50, does that significantly damage the economy until the next meeting?
I don't think so, because the market's priced in a lot of rate cuts between now and the end of next year. And so, we know where we're headed to much lower short-term interest rates. All we don't know is the speed in which how we're going to get there. And I don't think the speed matters that much because, if the Fed's going to cut rates a lot in the next, 12 to 18 months, that gets priced into the bond market, that gets priced into mortgage rates. And so the economy gets a benefit of those rate cuts before those rate cuts actually materialize.
How much, Bill, do you think the Fed is actually concerned about the market reaction to this? The last time we had a major shift in monetary policy cycles, there was a lot of talk by Jay Powell about financial conditions, about the reaction function in the markets. Is that concern as present now as it was then?
Well, I think they view financial conditions as their friend right now because financial conditions are easing even before they've actually been forced to act. And so that reduces the lags of monetary policy in terms of how monetary policy affects the economy. We've already seen long-term mortgage rates, for example, come down quite a bit. We haven't seen the consequence of that drop in long-term mortgage rates for housing activity, but at least that first stage has occurred where housing is more affordable now than it was a few months ago.
When we talk about this potential for the start of a major easing cycle, Bill, we'd be remiss in not pointing out that there are a lot of fiscal conditions, government conditions that the Fed is at least going to have to pay attention to, probably much more than they would have had if they had started this, a couple of years ago here. What's that discussion like behind closed doors when they have to talk about something that effectively they have zero control over?
Well, the Fed always takes the world as it is, not the world that it hopes it might be. And I think, if you look at the candidates' proposals, the Trump side in particular would really blow up the budget deficit over the next 10 years. The Harris is a little bit more ambiguous. And so the Fed knows that the fiscal stress is going to be probably sustained for quite some time. But it's probably not necessarily going to get worse than what it is today. I mean, if you look at the Congressional Budget Office, which makes projections over the next decade, they have them staying about the same level as a percentage of GDP, about 6% of GDP over the next decade. That's not good by any stretch of the imagination, but it's not, dramatically worse than what we have today. So I don't think the fiscal outlook in the near term is going to be a big driver of what the Fed does. I think the Fed's basically going to react to what they see in terms of the risk on the labor market side. So watching the unemployment rate, the payroll employment growth, wages, layoffs in particular, any signs of growing weakness in the labor market are going to accelerate the rate of Fed rate cuts.
So let's get more then into some of the candidates' proposals on the economic side. You had a piece out in Bloomberg Opinion yesterday talking about the high tariffs proposed by former President Donald Trump. You say high tariffs, weak dollar, a recipe for disaster. You write, as long as the U.S. keeps borrowing at the same pace, the policies of higher tariffs and a weaker dollar are fundamentally at odds, and a bigger deficit means less savings, which means the dollar would have to appreciate even more. So can you just sum this up for me in terms of why this economic proposal is so off?
Well, it basically wouldn't work. Trump's basically proposing that I'm going to raise tariffs a lot and I'm going to intervene and push the dollar down in value, and that's somehow going to solve the trade deficit. But that misses what actually causes trade deficits in the first place. The reason why we have a big trade deficit is we have a shortage of domestic savings relative to domestic investment. The personal savings rate right now is running around 3%. We have a large fiscal deficit. And so, we're essentially spending beyond our means. And so we have to import that capital from abroad to fill that savings shortfall. And that capital from abroad is in the form of a big trade deficit. So if you're a candidate Trump and become President Trump, and all of a sudden you enact all these things that are going to blow out the budget deficit even further, that's going to exacerbate the savings shortfall, and you're going to need a bigger trade deficit, not a smaller trade deficit. So the notion that the dollar would go, would depreciate in that environment is probably pretty unlikely. The dollar would probably have to strengthen to generate that bigger trade deficit.
There is so much debate, though, as to whether those higher tariffs are going to be good or bad for the economy and who actually winds up paying for it at the end. Walk me through your thinking.
Well, most economists are pretty, they don't agree on. We don't agree on everything, but we agree on one thing: the tariffs are a bad idea generally, unless you're doing it for sort of strict, for national security kind of reasons, because they basically distort trade. They push you away from doing the things that you have a competitive advantage to doing things where you're probably less effective. They're also bad because the burden of tariffs are not felt by foreign producers at the end of the day. They're felt by domestic households. And what's interesting about the Trump proposals is they would be bad for the core constituency that Trump has attached to him. Low and moderate income households that support Trump would be the ones that would pay the biggest burden on these tariffs.
Is there any way to blunt that impact through monetary policy? I mean, given how blunt that policy is?
Not really. I mean, obviously, if you had higher tariffs, you'd have more inflation, and the Federal Reserve would have to take that into consideration in terms of the monetary policy path that they chose. But, the Fed's not going to make any decisions about this for many, many months. The Fed doesn't set policy based on what might happen in the future. They set policy on what's happening today. So first we have to settle the election, then we have to see what the incoming administration does, and then only then would the Fed start to react to that in terms of how they set monetary policy. So that's still many months down the road.
All right, well said, Bill. Always great conversation. Bill Dudley is a Bloomberg Opinion economist, senior advisor to Bloomberg Economics, and of course, former Fed. Coming up here, we're going to talk about that broad retreat that we're seeing in tech stocks, that broad retreat that we're seeing in chips. The Philadelphia Semiconductor Index down about 4% on the day, almost 12% on the week. And we're going to talk about why Broadcom is the focal point of that. It's the stock of our hour, and it's up next. This is The Close on Bloomberg. All right, the Philadelphia Semiconductor Index right now headed towards its worst week since at least 2022. And a big part of that is because Broadcom right now on a daily basis having its worst session since 2020. For once, NVIDIA isn't to blame. It is our stock of the hour. Abigail Doolittle joining us right now to break it all down for us. We had those Broadcom earnings earlier this week, Abigail. They were not good for Broadcom, but a lot of people seem to be extrapolating something broader about the health of the chip sector.
Well, I think when you put the Broadcom results together, they beat in the quarter that was, but it's the guide for this current quarter. Their revenue's coming in a little bit light, $14 billion, pretty healthy. Interestingly enough, their AI business is very strong, but it's the other revenue that's not strong, and that's what's worrying people. But I think it's when people connect that with the NVIDIA quarter that was reported last week, where they beat and they guided higher, but it wasn't the crazy growth and the crazy beat that they've been doing for a year. I think that it's the fact that you had NVIDIA at one point up 180% on the year. You had Broadcom up, in a huge way in the year. Price to perfection. These companies are delivering okay, but certainly not perfection. In the case of Broadcom, they didn't even meet the guidance. So I think that it's just causing a real sentiment shift. The investors are scrambling, basically. It feels like maybe the music is stopping and investors are scrambling for their seats.
Well, okay, in terms of that, though, it hasn't run up as much as NVIDIA. So I am interested as to how much downside there really will be, considering NVIDIA was flying high for so long.
I think there's tremendous downside just from a pure technical standpoint. Well,
for Broadcom.
Well, for the entire chip space and maybe even technology more broadly. I mean, we all know that I like a good chart, and the stocks right now is caught in a pretty good congestion pattern where it looks like there could be a lot of selling from here. I mean, NVIDIA right now is already down 30%. It's already deeply in a bear market. I think that NVIDIA is really the one that we want to look at for the overall space. The rest of these stocks, I mean, Supermicro Computer, this stock, while not so influential on the S&P 500, just because it also didn't put up the kind of results that it had been putting up right now from its peak, and it's breaking down 70% in just a couple of months. That's the kind of breakdown. Investors got too far over their skis.
Too far over their skis, but that was the rally. So, I mean,
that was the rally.
So should we be looking at this and being more concerned about the broader market? I mean, tech was the leader all year long.
Yes.
It's not anymore. I just looked, actually, believe it or not, utilities on a year-to-date basis.
So getting defensive.
The best performing sector in the S&P 500. But I'm sure if you were to break that down on a month-to-month basis, most of those gains in utilities are really in the last few weeks.
Yes. Well, it's a great point that you're making.
Yeah.
Chips a big piece of the tech sector, of course, and I think that you're correct. I think that we should take this chips weakness, especially since it's a leading tell on other broader indexes, because these chips are used in literally everything that we use, as a sign that we're going to have some corrective action for the S&P 500 and the Nasdaq. All of these indexes are frankly caught in reversal patterns, just telling us that investors got a little bit too complacent. They were buying the hype. What's interesting about this is almost sell the news of the Fed cutting, because there's been this expectation that the Fed was going to cut. Now we know it, and I think that's a big piece. Plus, bring in the yen. The yen is strengthening, and that's a concern.
All right, Abigail, do a little closer look here at our stock of the hour, really a broader sector here and how it could weigh on the broader market. A focus on tech and breaking news right now in the world of government and politics. We are learning that Biden aides are working on a proposal for a U.S. sovereign wealth fund. This is according to a person familiar with the effort that our Bloomberg reporters have spoken to, saying that aides to President Joe Biden have been crafting a proposal to create a sovereign wealth fund that would allow the U.S. to invest in national security interests, Alex, including technology, energy, and critical links in our supply chain.
This is fascinating to me.
Absolutely.
How much do you have to export to get that? Like, what happened? I don't understand what a trade deficit looks like if you need to sort of supply that sovereign wealth fund. Sovereign wealth funds like Norway and Saudi Arabia, they pump so much oil. That's what they use the money for. What do we do with that?
Yeah, and we're not exporting enough. We should point out here that this looks like it does kind of mirror a proposal that former President Donald Trump has recently floated while he's out on the campaign trail. We're going to try to get you some more details on that, Alex, and figure out whether this would even fly in any sort of realistic scenario.
Huge statement, though. All right, coming up, we're just about 15 minutes away from the closing bell on this Friday. We're going to wrap it up here with technicals. John Kosovos is Chief Technical Strategist at Macro Risk Advisors. This is The Close on Bloomberg.
Some global nervousness around the fact that we've really come to rely on the U.S. as the engine of global growth. And to the extent that that is sputtering a little bit, again, nothing looks outright disastrous, but if we're relying on the U.S. as the engine, that engine is losing some steam.
Julia Coronado over at Macropolicy Perspectives kicked us off for the close just about 10 minutes ago, Alex. Obviously, a big focus on that labor market data that we got this morning, but there's a whole lot more going on and that's driving this market lower.
Yep, and you have the tech route as well. You got the Nasdaq, kissing its 200-day moving average, the S&P rolling over as well. The semis just continue to get hit. The superlatives are so dramatic. Like the SOX index is looking at its worst week, since 2022, and you see the jump in the VIX. Something crazy, right? Like we're not hitting 50 or 60, but it's been a slow, continued grind higher.
Yeah, it's a good point. It is elevated, but we aren't getting that spike, that panic spike that we saw, of course, at the start of August. But still some concerns there. 54.14 and change on an S&P 500, not far off the lows of the day. And more importantly, the S&P, the Nasdaq, and some of the other indices now testing some of those key moving averages. John Kosovos is the Chief Technical Strategist at Macro Risk Advisors. He joins us now to count us down to those closing bells. And I do want to start with some of those moving averages, John, because it seemed like, I can't remember the exact date, but it seemed like just a few weeks ago, towards the end of August, we were in spitting distance of a fresh record high for the S&P 500. But obviously, we've drifted way afar from that over the last few sessions. What's going on?
So, yeah, and thanks for having me on, and happy Friday, everybody. Can't believe it's only been a 4-day week. Feels like a lot more than that. Yeah, when I look at the markets, I think the main thing I think we got to think about is that there's a lack of support out there right now, whether it be on the macro front or even on the AI and the semiconductor front. Without the support in those two pillars in the market, I think we have to continue to be a bit cautious here. And it's not really too surprising that we're starting to notice these moving averages, which are a measure of trend, starting to be tested here.
Okay, so what happens?
What happens? Well, it depends. So it depends on how trends progress from here. So one thing I think we need to be mindful of is one on the macro side of things. Cross-asset implied volatility is still very, very, very high. Whether it be VIX, whether it be currency vol, whether it be commodity vol, when that's still high, there's still an outside chance, an elevated chance of a tail risk move, meaning the market could have an air pocket, and over the course of a couple of days, we could continue to be in a correction and possibly even into a bear market.
Yeah.
So until we see that start to stabilize, folks are going to be de-risking.
I am curious here. I mean, specifically when we're looking at technical levels and just this idea of support, and I'm just going to take the S&P 500 just to keep this simple, because I was looking it up. The support level on the Bloomberg terminal right now is down around that 53, 67, 68 level. We're at 54.09. That's a pretty big gap from where we are today and where that first line of support. Is that a positive sign, or should I be worried, John?
That's interesting. I think the way you need to look at it more is the speed in which the market has declined from the highs. So let's take a step back, okay? So the market peaked somewhere around that 56.60 level back in July. We had a big swoosh lower, got really close to that 200-day moving average you were mentioning a second ago, and then we rallied again within splitting distance of that level. We could not break out above that. Then what has happened this week? We saw 2 sharp days lower, okay? And now today we are undercutting that 50-day moving average like a hot knife through butter. It's the speed of the move when you break through levels that's more informative than necessarily where the distance is, okay? So let me take another step back. Now, if you're bullish and you think we're still on an uptrend, which I do still think we still are in an uptrend, we're getting close to a support level that where the market should start to stabilize, call it 5,300. Failure to do so, though, this is where the technicals kick in. You fail to hold that 5,300 level, then what's going on, and what has been going on since July, is starting to look more like a double top, okay, where the market is actually putting in a proper transition from an uptrend to a downtrend.
Okay, so let's break this down more specifically when it comes to, say, tech, right? NVIDIA, like kissing that $100 share level, and the SOX index now having its worst week since back from 2020. Can we understand the downside for chips right now?
All right, so with the semiconductor index, yes. So today it's breaking underneath its 200-day moving average quite aggressively. Its rally in August was nowhere near as strong as the rally as the S&P or even equal weighted S&P 500. So the risk here right now with the SMH is that it is tracing at what is commonly known as, and Abigail was hitting at it a second ago, is what is a head and shoulders top formation. And that is, again, an indication that the uptrend is starting to reverse, that there's distribution in the marketplace, that there's a lot of overhead supply that's going to limit rallies going forward. So the risk here is one. We move down to 200. That is major support on the semiconductor index, or SMH. Where is that? That's the April lows, essentially. You break that, the downside risk from there is to about 140. It's another 30% decline from that level. That is the implied move from that so-called pattern. Well, we get there is not guaranteed, but that is the risk. That's how things are starting to shift. And why I mentioned earlier, like we're losing that AI support in the market, and you need that for the math to work if the S&P is going to continue to push higher.
So, I mean, I guess the question is sort of what arrests that? I mean, do we have to turn our attention back to, I guess, the corporate fundamentals, or is this more sentiment driven?
I think right now it's more sentiment driven. The market has not been able to reward good news. Let's put it this way. I'm not a fundamentals, I'm a chart guy. But from what I can tell with my CFA is that NVIDIA had pretty decent numbers, but it just wasn't good enough. So it's an expectations thing here. So the market's not rewarding good news, nor is it able to shake off any sort of bad news. So we're stuck in this feedback loop right now where selling begets selling. So it's a sentiment thing. From when it comes to, I've heard folks talk about valuation. Sure, I would put valuation into a sentiment category. So back in June, my call was that semis needed to correct. Why? Because of their deviations from trend. There were like multiple deviations from the 200-day moving average. And Backtest said that they needed to come in on average anywhere between 20 and 30%. Now, lo and behold, where we are, now we're starting to look more like a top pattern is there. So the key thing there is that 200 level, those April lows are vital for semis, and I would say also vital for the market itself, maybe more important than 5,300 on the S&P.
All right, good stuff, John. Going to have to leave it there. Chief Technical Strategist over at Macro Risk Advisors, helping us count you down to those closing bells here. on an awful Friday afternoon, Alex, as stocks now retesting those session lows, 5407 on the S&P 500, the NASDAQ now down about 2.7%.
And all sectors in the red as we speak. Communication services, consumer discretionary, tech, the worst performers, even real estate, healthcare and staples. They're also all in the red. So hard to find that safety out there on a day like today.
We're not talking much about yields, though. You are seeing, though, a bit of a drop there in that 2-year yield here, heading, of course, out of that jobs report and into a CPI report next week, which I keep forgetting about.
Yeah, and also how we re-rated from being inverted to now disinverted by about 6 basis points in like 2 days feels tremendous.
A lot to break down. Don't go anywhere. It's coming right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you to the closing bell. A global simulcast starting right now. Scarlett Fu in the TV studio. Tim Stenovic in the radio booth. Emily Grafeo by his side in place of Carol Masser as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. As stocks right now, Tim Stenovic, retesting those session lows. The S&P down 1.7% on the day.
Yeah, set for the worst week, going all the way back to March of 2023 when we saw that regional banking crisis. I mean, in the S&P 500, Broadcom, Tesla, Supermicro, just dragging down the S&P 500.
And tech doing even worse here. The NASDAQ 100 down 2.7%. There was really nowhere to hide. That safe haven trade in tech stocks is just not working today.
You know what's performing a little bit better in that it's not down as much? The Dow Industrials on a day in which volume is a very healthy 19% above the 20-day average.
Yeah, and also if I just look at small caps for a second, like they're definitely down, but just by 1.8%. So definitely performing better, say, than tech.
Yeah, and we were just talking with John Kosovos about some of those technical levels, the retesting of some of those key moving averages, where the next line of support is here. And you wonder, is this going to be a move, meaning heading into next week, that is going to be technical driven, fundamental driven, or macro driven?
I think the answer to that's yes. I think you have to put all three of those together, right? You get the CPI, which is going to be macro. We're obviously going to be looking at the debate. And then in terms of the micro, I don't know what we have, right? Earnings are going to be in a stall point, so that's going to be a little difficult to get a better read.
Yeah, the stocks right now down about 4.5%. Your 2-year yield down about 8 basis points here, and your VIX elevated here on the day right around 22. Let's walk you through the numbers here in New York as we get the closing bells with the Dow Jones Industrial Average closing out the day down by 1 percentage point, roughly about 400 points. And believe it or not, that's actually your outperformer on the day. On a weekly basis, it's down about 2%. The S&P 500, though, having an awful day, 1.7% lower than when it started the day, more than 3% lower than where it started the week. The NASDAQ Composite down about 2.5% on the day, 4.7% on the week. And let's take a look at that Russell 2000, which is going to close lower by about 1.9%.
In the S&P 500, you had more than 4 out of every 5 stocks lower on the day today. 418 moved lower, only 82 ended up moving higher, Scarlett.
All right, let's take a look at IMAP. It should be a pretty easy read today. There's lots and lots of red. There are little slivers of green there. And why don't I tell you the biggest decliners first, right? You've got certainly the tech sector, whether it's technology, whether it's communication services, whether it's consumer discretionary, all of those are down at least 2%. Now, the ones that are kind of outperforming by just a hair, consumer durables and apparel ever so slightly, real estate investment trusts, a little bit of green, but this is a pretty broad retreat, everyone.
All right, well, it did manage to find some gainers today. It was not easy. I do want to start with U.S. Steel, ticker X, up more than 4% today. This after Cleveland-Cliffs CEO said that he's absolutely in the market for his rivals' assets. He told CNBC that he's working with investment banks JP Morgan, Chase, and Wells Fargo on a plan. He made these comments yesterday after the market was closed. Shares of U.S. Steel moving higher today. U.S. Steel, Cleveland-Cliffs, and JP Morgan didn't immediately respond to a request for comment from Bloomberg. Wells Fargo declined to comment. Remember, it was just Wednesday of this week when President Joe Biden said that he was said to be preparing to block the Nippon Steel deal. Also, how about a little bowling, everyone?
Okay.
B-O-W-L. Bolero, they got more than 350 locations in the U.S., Canada, and Mexico. The company reported revenue for the fourth quarter that came in above the average analyst estimates. Shares higher today by more than 6%. And this is a really interesting one on a day when speculative corners of the market are not doing so well. GameStop actually rose today. Shares higher. This after the man known as Roaring Kitty posted to X for the first time in a few months. Shares higher by close to 7% today. What happened? Shares up more than 30% so far this year. The company is going to report earnings after the bell on Tuesday.
That'll definitely be an interesting one to watch if they have many earnings to report, Tim.
If they have any earnings to report.
I was going to say, what
I should say they're reporting results after the bell.
Right, their losses. I'm looking at the decliners. No surprise that those semi stocks getting hit really on the week, but also today, Broadcom down about 10% after the chipmaker gave a revenue forecast that was seen as disappointing, extending losses after their earnings miss that came after the bell yesterday. They see revenue at about $14 billion versus estimates of $14.13 billion. I think really underscoring just how high the bar is for these chip names after the rally we've seen all year. In Broadcom today, trading volume was quadruple the average for around this time of day. I'm also looking at Super Microcomputer, those shares down as much as 7.6%. JP Morgan downgraded the server company to neutral from overweight. And of course, the move comes in the wake of a delayed 10K filing for the company. The company said it needed more time to assess its internal controls. And then finally, I'm looking at Elf Beauty. Couldn't really find what was driving the stock lower, at least today. But earlier this week, we got some Nielsen-tracked channel point of sales data for the makeup company. An analyst called out weaker than ideal 4-week acceleration, and they called out a deceleration in the 2-year growth performance. That stock down 18% on the week and down about 10% today with the broader market falling.
This is really all flying in face of my invest in your face thing when these companies report and they are struggling or there's some negative press around them. Okay, let's get to the bond market here. There was buying pretty much across the curve, a tiny bit of selling, and I mean tiny, in the back end. But the front end, look, up by 8, down by 8 basis points. You're taking a look at the 210 curve, closing on inverting for the first time since July 1st, 2022. You're looking at about a 5 basis point difference. Might not seem like a big deal, guys, but the speed with which we re-rated in the last couple of days feels very tremendous.
Yeah, and that was a great point that I think John Kosovos made as well here about kind of the speed of the descent here. And there are going to be a lot of superlatives on this day, of course, that we're crunching those numbers now. But it gets to this idea here that what is there to save this market? Earnings season is over. The Fed is going, thankfully, into a quiet period. And now you basically just have the markets left to their own devices.
Okay, well, let's talk a little bit more about these markets. Look at the SOX this week, having its worst day going all the way back, or worst week rather, going all the way back to March of 2020. Certainly NVIDIA and Broadcom, a big part of that. But if you look at the SOX today, guys, every single component of the 30 stocks that are in the SOX down today, down another 4.5% today. What's the message that that investors are sending with selling semiconductors?
Are you going to buy one of these Apple iPhones? I hear they have this big announcement coming up next week. And, it's supposed to be AI enabled, though not quite AI enabled.
I'm not to get more thumbs up things to do your FaceTime.
I don't think you need a new iPhone for that.
I don't?
No.
I heard the iPhone 17 will be a bigger deal than the iPhone 16. So if you're going to hold off.
We're already on the iPhone 17 super cycle now?
So is that next year then?
Yeah, that's not even 2020.
Have we talked about this, though? I mean, you guys are raising a really good point, which is the idea that the upgrade cycle has gotten a lot longer for people. Yeah. And this makes up 50%, roughly half of Apple's revenue. And it's a really important, it's a crucial device for the company. But if they don't offer something that, prompts people to upgrade, then people are going to wait for longer to upgrade.
And it's also part of the Broadcom supply chain. As we were talking about earlier, Tim, Broadcom is a big supplier for chips for Apple.
I feel like you just need to invest in the you break it, I fix it, like whatever Apple repair company is a better bet than the Apple refresh.
Won't you get sued for that or something? Don't Apple come after you?
No, but if now, everyone's past their manufacturer warranty anyway, so because we're all holding on to them for years and years. There's a great story today written by Elena Pang about how the way that we're eating is totally changing. Americans' love of cheese has drawn $4 billion into new factories. We keep talking about this manufacturing recession, not when it comes to building factories.
Whoa. What the heck is that?
That's cheese, everyone.
Okay.
That's what we eat?
I thought cheese grew on trees.
Who likes the cheese? I love the cheese. Romaine does not like the cheese.
No, I don't. Particularly after seeing that video. I never want to know how the sausage is made or the cheese.
Tim?
We have a great cheese shop close to where we live.
Yeah, well, we're part slopey people, so that's
Fancy
it.
man,
Emily,
those
are you a
cheese
cheese
shops.
person?
I haven't met a cheese that I don't have an appetite to try. I will pretty much try any cheese.
I'm wondering
that
how
looks
much
good.
4 of the 5
That's
of us
delicious.
are responsible for the $4 billion in new factories
Wonderful.
that dairy processors are planning across the U.S. to meet
$4
the
billion
surging demand.
worth of this stuff gets sold. Is that what you're telling me?
$4 billion to put into new factories to feed us the cheese that
And they just
apparently
pump it out
the
through
three of you are
a
really
little hose
into.
there.
Like, I don't know.
Do they clean that hose after every pump?
Yes, they clean the hose.
No
Are you
cheese.
sure?
Very sanitary.
Are you sure,
No cheese
Alex?
whiz. No cheese
Also,
whiz
like,
for romaine.
we like the mold. The mold is good.
Right.
What?
It's
Just-
aged.
Yeah.
I'm so not into cheese.
Oh, gosh, Alex.
All right, I'm told we have to go. Happy Friday, everyone. Eat some
Which
cheese.
part was the mold? Was it the white part or the...
That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're headed back to radio and YouTube. Alex is heading out to start the weekend. Scarlett and Romaine are going to continue on TV. We'll see you same time, same place on Monday.
And our coverage does continue right here on Bloomberg Television. Apple is set to launch its new line of iPhones. We're going to learn exactly what they're planning with a deeper dive into the tech giant's big event. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. An awful day on Wall Street, an awful week if you really want to put it in that context here. A market here that really had to take a closer look, not just at economic conditions, but also that AI trade, also consumer sentiment, and of course, that big jobs report. These are the weekly numbers that you're looking at behind me, and S&P 500 having its worst week, I should say, in about a year. The Philadelphia Semiconductor Index having its worst week since the onset of the pandemic in March of 2020. And this was a cross-asset sell-off as well. Weakness that we saw in the crude oil market earlier in the week continued on this Friday, a 7% drop for WTI crude. And if you're looking any refuge in those safe haven assets, and if you thought Bitcoin was one, well, you would be wrong. Down 9% on a weekly basis, retracing almost all of the gains going back to April.
Yeah, it was very much a risk-off day, and this earnings season has really proven that AI is everything and the outlook is everything. But apparently not so, because Broadcom has raised its full-year forecast for AI-related sales to $12 billion, which is just above analyst estimates. But its non-AI businesses are growing more slowly than anticipated, so that led to investor disappointment. The stock down the most since March 2020, but it's still up around 23% so far this year. We're also looking at NVIDIA because it's been a roller coaster week with lots of legal headwinds facing it. The net effect, though, is the stock action is that it's down for a third day in 4. It's now lost about 18% since its second quarter earnings report, in which its sales forecast missed the highest estimates out there. And I did find a gainer, Samsara. The ticker is IoT for Internet of Things, because this is a software company that helps other companies manage their Internet of Things data and optimize their operations with that data. It had a beat and raise quarter, and the stock is now at a record high. Now, that doesn't take away from our top story this hour, which is big tech in big legal trouble. Maybe. NVIDIA this week acknowledged that it's in contact with the Department of Justice, answering questions in response to Washington's antitrust probe. At the same time, the AI chipmaker and Microsoft face a lawsuit accusing them of forming a buyer's cartel and infringing upon patents. None of this is helping their share prices, with the Mag 7 rounding off its worst week in more than 4 months. Now, maybe Apple can shift the narrative on Monday when the company launches the new iPhone 16. This is a device that will take Apple into the AI era eventually. Romaine?
Well, we hope it does, of course, for the sake of the broader market and, of course, the moves that we saw today and this week, maybe giving some folks concern. So let's break it all down on our Factor Friday with Chris Cain, Bloomberg Intelligence. It's best here to talk about the factors that move the market. And you really took a closer look, Chris, at the factors within the tech sector. What did you find?
That's right. Yeah, just to be clear what's going on here, right? So typically in factor investing, you take a universe of stocks, like the S&P 500 or Russell 1000, measure all the factors, and then create long-short portfolios, like go long the top 20%, short the bottom 20%. We did the same exact thing, but we just used tech, right? So like what characteristics, what factors are working within tech? What we found is low vol, quality, and momentum have all worked, all up about 15%, meaning low vol beat high vol by that much, and vice versa. Value is about flat. Small size was down, but it was those first 3 factors that really have worked. low vol and quality are like more defensive type factors, so that's been working for a while. Momentum right now has a lot of overlap with high quality, so that's also very correlated. And just for low vol, that really extends a multi-year run for low vol tech. I mean, so if you go back to 2021, low vol tech has beaten high vol tech by about 85%, and it's really accounted for almost all of the gains of the sector in total. So it's still that low vol group within the tech sector, we think is probably the best way to play a tech exposure.
That's a fascinating way to look at this, to kind of dive it into techs like that.
Yes.
So basically defensiveness within the sector.
Yeah, I love that.
Yeah.
So give us some names here. What are examples of tech stacks in the low vol group versus the high vol group?
So the low vol tech group, it's a lot of established, bigger companies, those huge mega caps. So Apple and Microsoft are the headliners there, the stalwarts, right? And other kind of older school tech names like Texas Instrument, IBM, right? That high vol tech, it tends to be smaller stocks. It tends to be stocks in, industries that are just starting. So things like Wolfspeed, MongoDB, Palantir, even NVIDIA. That's certainly not a small stock, but that's also in that high vol tech group. So it is certainly more defensive in the low vol.
But thank you so much, Chris Cain of Bloomberg Intelligence, giving us some insight into the factors within the tech trade. Some of those stalwarts, the low vol tech names, they're also big targets for other companies, especially when the AI frenzy kind of dies off a little bit.
Yeah, it'll be interesting too. And someone brought this up too. They were actually saying that maybe this sell-off, at least for some companies, could actually be a good thing because then it does sort of raise the possibility for some activity in the M&A space.
Yeah, although the government's looking very carefully at all of that.
Oh, the government.
Coming up, investors weigh the staying power of this AI trade that we've just been talking about. Robert Cote is CEO of Cote Capital, and he joins us next to discuss all of that. This is The Close on Bloomberg.
All right, we've been talking a lot about tech, and for good reason. It has been the main market driver on the day. It's been the main market driver really all year long. A big focus on AI giants like NVIDIA and Microsoft, and we're now learning that they're battling a new lawsuit. The two companies are accused of patent theft and violating U.S. antitrust law by a Texas-based company called Zockets. We did reach out to both Microsoft and to NVIDIA, and both companies did decline to comment. We have with us right now Robert Cote. He's a lead investor and a board member of Zockets. He's also the CEO of Cote Capital, and for years has been one of the top intellectual property lawyers in the tech space for decades. Great to have you here on the set, Robert.
Thank you.
Let's start off with this and kind of break this down in layman's terms.
Sure.
What the main allegations are against NVIDIA and Microsoft.
Twofold. One is patent infringement, one is antitrust violations. So Zockets developed a new chip in the cloud. It's called the data processing unit. The architecture behind that allows you to take all the data work that you need to do when you train a model. Distributed computing means many computers working on the same job. In fact, thousands of them to train an AI model. To get the speeds to a point where it doesn't take years, but it takes weeks or months, you need this data processing unit. You have to change its architecture. Computers usually go to memory, and when you go to memory, you're too slow. Packets are moving at billions of packets a second in the network, so you need a new architecture and a new processor. Zockets developed that. The industry copied it. It took years for it to make its way into the cloud. New innovations takes time for people to change. We made an attempt, because litigation is not something that anybody should ever do lightly. We went and spent a year developing the record on the infringement, validity of these patents, and damages. We have a market rate in a license agreement. We looked at what the value was, somewhere on the order of $40,000 a server, and there are millions of these servers. And so essentially we did that work, we took it to an investment bank, we made an attempt over the past several months to sell. And so our antitrust violations is the other aspect of this. We made every effort to avoid litigation, and we wound up in the sales process being boycotted. Not one of the large clouds or large chip makers, not two of them, not some of them, all of them. And then RPX, which is a company that is was backed by big tech, and they pay subscription dues. I showed up at our front door to negotiate on their behalf. If you read their website, they attempt to act on behalf of the cartel. They call it their clients. It's a euphemism on behalf of the cartel to buy at wholesale. and instead of retail, meaning fair market value. And the problem with that is that's against their interests. They're competitors of one another. They should be competing for access to rights that are critical to AI.
I'm sure you're aware of some investigations that we now know are taking place here in the U.S. In the AI space and the chip space with regards to potential antitrust concerns. This is based on Bloomberg reporting. Are you involved in that in any way?
I am not. It's related to what we're talking about here, right? Those are allegations around tying the components, the CPU, the GPU, and the DPU into a package that I, as NVIDIA, are the only supplier of those components, so no competitor in the chip industry or otherwise can get access into that system. There is technology, they would argue, is the advantage that allows them to tie all those components together and exclude competition. And because they partnered with Microsoft as part of this copying of the Sockets technology 5 years ago, both NVIDIA and Microsoft were way out ahead of everyone else. And Microsoft has monopoly power in using those NVIDIA servers to train AI models. They have an exclusive with OpenAI that gives them access to some of the most valuable AI training models in the world. And so they sit in the catbird seat, very much in a position of holding the reins of power. And we have to be very careful when we allow big tech companies to hold the reins of power. And we see the problem with Sockets. They're denying IP owners that are critical ingredients into that system compensation. In fact, they're not even talking to an IP owner.
So you say that you tried very hard to avoid litigation. I assume that means that you've tried to talk with them about some kind of payment. Are those talks still ongoing or have those ended?
So we ran an investment banking process to try to sell exclusive rights, either the whole portfolio the company owns of critical technology behind that DPU, that enabling component in their AI system. We did that over, I would say, from March until about last month. And we reached out to both Microsoft and NVIDIA multiple times by email, heads of legal, heads of corporate development, and we were rebuffed. We didn't even get an answer. And so there was no good faith effort on their part. I can tell you when I started in the business 20 years ago, 25 years ago, you wrote to somebody and you had a serious claim that they were using your IP. They didn't ignore you. They actually did their homework. They entered into good faith negotiations over compensation for use of those rights. Today, we have a thing called predatory infringement. It's a playbook where David is blown off because 99% of Davids can't afford the multi-million price tag to bring a lawsuit. And the 1% that can are in a war of attrition. So we happen to sit in a very special position as a company, but if they can do it to somebody like Sockets that's done something so critical to enable AI and deny them any competition, imagine what's happening to the rest of the innovators that are the kind of the bedrock of the American dream.
I hear you about the David versus Goliath. I mean, one can make the argument that the tech industry got to where it is with people not necessarily stealing each other's ideas, but copying each other's best ideas and, like, you know, putting a twist on it and making it their own. How is this different? Why is this predatory infringement and off a playbook versus just another example of that tradition of innovating off of each other?
So the Constitution protects for the people from around the world. It's the way we built the empire in the first place. Exclusive rights so that investors will invest in David, knowing that David will get compensated if his IP is used. Otherwise, he won't invest. And the whole innovation economy that built this country is irreparably harmed. And we have a real problem with that. China is outpacing the U.S. in many different technology domains as a consequence of that. But to answer your question maybe more specifically, what you have to realize is copying is illegal, right? But when you publish your patents, you're sharing with the world so that the world can innovate on top, to your point, and progress humanity, progress technology, progress society. But it doesn't mean that the IP owner whose IP is a critical ingredient in the cake that you're making should be denied any compensation.
You are certainly going to get pushback on this. I'm not just talking from the big tech giants, but we went through this kind of process before the last big tech cycle. And you had a lot of folks come out with these patents saying, we owned this before Apple did this, or Microsoft, et cetera. They were derided as patent trolls, and some of them really were trolls.
Correct.
Why is Sockets different?
So what happens is a legal system, becomes out of balance. And so this case isn't just about Sockets, it's about bringing back balance to our innovation economy and to our legal system. because it's not just the patent trolls, it's the good guys too. Every innovator is being boycotted, and that's where we run afoul of the law, right? And that's what I'm here to stop. Break up that cartel and make sure we bring back balance to a system that's become way out of balance.
All right, Robert, we're going to have to leave it there. Obviously, this is a very complicated subject. We want to talk to you again about this. We should point out, of course, that we did reach out to both NVIDIA and Microsoft for comment on this, and they declined to comment. Of course, we will welcome this on the show anytime to respond to the lawsuit. Robert Cody, he is the lead investor and a board member of Zackets. We'll be back in a moment. This is The Close on Bloomberg. All right, let's take a look back at this day in history. This day, September 6, 2008, when Fannie Mae and Freddie Mac, the largest mortgage finance companies in the U.S., were seized by federal authorities. It was a hasty attempt to staunch the bleeding of a prolonged credit crisis that really was the fulcrum for the worst global economic catastrophe since the Great Depression. Fannie and Freddie weren't just any old mortgage companies. They purchased home loans from banks, repackaged them into securities. Some of those were held on its books, others sold to investors around the globe. By the 2000s, Fannie Mae alone was one of the 5 largest companies in the world by balance sheet assets, and together with Freddie Mac, responsible for half of the U.S. home loan market. But lax lending standards, absent oversight, and speculative investors eventually took a toll, with housing prices in 2008 tumbling 20% from their peak, leaving at least 1 in 5 homeowners paying mortgages that cost more than the actual value of their homes. That slowed consumer spending, crimped GDP, and caused more than $500 billion of losses at major banks. So a decision was made on September 6, a Saturday, to force out the executives of Fannie and Freddie and place the companies under U.S. conservatorship, aided by $200 billion in taxpayer money. It was one of the biggest government interventions in private markets ever. Now, as much of a no-brainer as it seems in hindsight, the seizure at the time, it was controversial. Fannie and Freddie technically had adequate capital, at least by legal definition, but the government would say that legal definition itself was inadequate.
Both agencies suggest, and it's probably true, that their statutory capital is adequate. But no doubt that by the end of September, when they had to announce quarterly results, that their capital would be significantly reduced. And so I have a sense that the Treasury wants to get in front of this and to inject some capital before the markets tend to take it the wrong way.
And initially, markets did take it in stride. An S&P home building index rallied 11% when markets opened on Monday, September 8th. But by Tuesday, the enthusiasm was gone. That index plunged 9%, and little did anyone know the market havoc that was set to be unleashed over the next 6 weeks, with the unraveling of several other financial titans, including AIG, Merrill Lynch, Washington Mutual, Wachovia, and Lehman Brothers. But we'll have to save those stories for another day in history.
All right, Romaine, we have some breaking news here. Big Lots has prepared a bankruptcy filing, and the plan here is to sell some stores. So Big Lots, the discount home goods retailers, getting ready to file for Chapter 11 protection from creditors as early as Sunday. This is according to people familiar with the matter. This is through a court-supervised process. It will continue to operate, so you can still go to a Big Lots and buy things. In fact, that's what they need you to do so that they can, start the process of lining up a process where they can negotiate with their creditors and perhaps come up with an agreement moving forward. But we'll keep you posted on all these developments. Meantime, we want to go now to Next Up, where we highlight the entrepreneurs and founders moving the needle for our economy, markets, technology, and our bellies. Rooted Fare is an up-and-coming condiment company rooted in the spirit of entrepreneurship and its rich Chinese heritage. Founded by childhood best friends who are second-generation Chinese Americans, the startup makes unique spreads that draw upon that bicultural identity. And they're also delicious. Hedy Yu is co-founder of Rooted Fair, and she joins us now from Los Angeles. Hedy, thank you for joining us. Most startups try to solve for a specific problem, and one problem that you encountered was going away to college and missing your food and your culture. Now, briefly explain how you turned that rite of passage into a company.
Absolutely. So, like you said, this was very much rooted in my own experience of kind of not feeling like I belonged on campus and just growing up in a world that celebrated the all-American girl. That's all I really wanted to be. But I found that I was leaving my Chinese heritage behind. And I myself wanted a product like this that had these classic, traditional Chinese flavors that I loved, but I yearned to have it in my everyday life in a way that already complemented my modern lifestyle. And so it really just started with us wanting something like this, and we made the product, we tasted it, we loved it, we shared it with our friends and family, and they loved it just as much as we did. And so they said, why don't you try, selling it at a pop-up, see if other people will buy it, and they did, and that's kind of how it all started. It all started from folks also loving it as much as we did.
Now we're looking at pictures of your first product that you launched, which is the Black Sesame Crunchy Butter. This is basically the same black sesame paste tucked inside tangyuan, which is a Chinese dessert of glutinous rice balls that's served hot in water. I looked at the ingredients of your butter, and there's no butter, right? Yet you use the word butter in the name. So I'm curious why you made that decision.
Yes, so very much because we wanted it to be recognizable to folks. So, this Chinese dessert is something I grew up with that is close to my heart, but growing up in America, so was peanut butter. And so this spread is very much just freshly roasted and ground black sesame seeds, some peanuts ground together. And so that's why we called it a butter.
I am curious, Hedy, when you talk about sort of building this business and expanding the reach of these products here, are you trying to appeal to customers like yourself, effectively Chinese Americans or other people who sort of miss or feel like they are not sort of represented on some of these store shelves? Or do you also have ambitions to maybe expand this to folks who've maybe never even tasted something like this sesame butter or some of these other products that we've shown up there on the screen?
Yeah, great question. So I really wanted to make this for my community, for people like me who really yearn for these flavors and find belonging and connection with it. But I've also found this is a great way to actually bring people and invite them into our universe as well. Just as, a dining table and food is the great equalizer and connector, we found that a lot of people have resonated with our story, even if they're not Chinese American or, don't even come from a different background, immigrant background. And so this is something that, Benny Blanco, he's a music producer, he included us in one of his favorite things in his new cookbook. We're also loved by, Chinese grandpas and grandmas. Everybody can enjoy this flavor with us.
What's the sort of a plan when you talk about trying to get, I know you can buy this directly from you, but what's the plan to get this into more retail stores?
Yes, I love it. Great question. We're going to slowly grow our e-commerce platform first. We feel like this connection with customers is really special and we want to really stay connected with them. So e-commerce is the way we're going to go. We also have limited edition stuff on our website that we're going to kind of keep there until we're able to scale. But we've started to kind of go across the country in these really gourmet and special mom and pop shops. And we're also in Bristol Farms in Southern California, and we hope to just continue our reach locally in Southern California and broaden until we're in stores everywhere so everyone can enjoy us.
I have 2 words or 3 words, dorm dining halls. I think that might be a good next step, given that you were in college when you discovered that this is something that would help you get over your homesickness. Hedy Yu, thank you so much. Hedy Yu is co-founder of Rooted Fair, which is based in Los Angeles. If I had something like this when I was growing up, I would have loved it because I used to eat tangyuan all the time, and this would have been like.
And so you didn't have anything like this in college,
no,
unless your parents sent it to you.
I just pigged out on French fries and drank hot chocolate. So yeah.
So the freshman 15, they hit there too as well.
Exactly. So this would have been an improvement on that. We had a roller coaster of a week. It was 4 days long, but it felt like it was 5 days.
Yeah, I mean this was a rough week, and I do sort of wonder how things reset when we get back on Monday, Scarlett.
Yeah, absolutely. S&P 500 closing out the week with a 1.7% decline, with tech leading the way down. This is the close on Bloomberg. for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Damola Adamolakin. There we go. He's the 35-year-old private equity executive who is plotting Red Lobster's comeback. He is the former CEO of P.F. Chang's, and he's a young guy, but he's got a lot of ideas about what to do with this chain that went bankrupt, partly because of the all-you-can-eat shrimp offering.
Yeah, I'm actually fascinated, particularly by him. We had a chance to interview him back in 2021 when he was turning around P.F. Chang's, and at least based on what investors tell us, he did a pretty good job with that, and eventually to see if he can work some magic with Red Lobster. I'm keeping an eye on Leonid Radvinsky, OnlyFans. You ever heard of that, Scarlet Fu? He's the owner, and apparently he was paid $1 billion in dividends from that company just over the last 3 years alone. That's an astonishing figure. We all talk a lot about the pay packages of some of these top executives, but I think there are some Wall Street banking executives who are even weeping when they see that $1 billion payout over 3 years.
Adult content can be very profitable.
It's not all adult, they tell you.
Okay, well, adult content, it could be all kinds of things, but it serves as adult entertainment.
Yeah,
it's
very profitable, though.
Yes.
There you go.
That's what we'll say.
And we'll leave it there.
Third on the docket is Selena Gomez. The actress and singer's rare beauty makeup has catapulted her to billionaire status. Pretty incredible here. She, does, what's the word? She's like a triple threat at this point.
Yeah. So
entrepreneur, singer, actress.
Yeah, I feel like we're going to hear more and more of this now. These celebrities have really started to get savvy, right? It's not just about acting or bouncing a basketball or whatever. It's about, leveraging your fame and using that to build products, build brands, and everything else. And now you have, at least on paper, a new billionaire.
And own equity. Equity is everything.
Oh, yeah.
All right, let's move on and stay in the entertainment space, but move on a bit here, because have you noticed old movies, they're making a comeback. The long-awaited sequel to the 1988 hit Beetlejuice hits theaters today. You know what it's called?
What?
Beetlejuice.
Oh.
Yeah, no.
Okay.
That
don't say it a third time.
I know, right? Deadline reporting the movie racked up around $12 million in previews. Ray Nutt is CEO at Fathom Events, and he joins us now to talk about this resurgence. So Beetlejuice is the sequel, but the original one is the one that's also getting a lot of attention at movie theaters in the big screen format. What's going on here? Is this because movie theaters had to come up with a way to show something after the Hollywood strikes limited the production releases?
Well, hi guys, it's good to be with you. We've been doing classic movies for probably over 10 years right now, and I think it did start off as supplementing, main movies and everything, but recently we've seen it just take off, and I think we did Lord of the Rings recently, and we saw what we saw there was over 2 weekends we ended up doing $8.2 million, and it was the trilogy that we showed and everything. And I think that woke a lot of people up. But recently we also did a 15-year-old stop-action animated film called Coraline, and we're just coming off that run right now where we did $32 million, and that particular film is going to be Fathom's largest film in not only this year but the history of the entire company. So there is a resurgence of classic films. Earlier this year, we did movies like Wizard of Oz, the 85th anniversary, Gone with the Wind, 85th anniversary. We do a lot of those classics as well, and a lot of people are bringing back their children and grandchildren to see these movies too.
Ray, it makes sense to me that Gone with the Wind or The Wizard of Oz is a classic movie, but Coraline doesn't strike me as a classic movie. And I'm wondering, going forward, if we keep this up, if this is a real thing that resonates with viewers, will it become more than just a re-release? Does it become like more of an event, like, I don't know, the Rocky Horror Picture Show, where there's live performances next to it as well?
So with Coraline, it's a really good example because it was remastered and brought back in 3D. And 65% of our sales were in 3D, which is unheard of. The last time we ever did anything like that was Peter Jackson's They Shall Not Grow Old. And we had 70% of our tickets in 3D. So I think that was an attraction. We did Coraline last year and did $7 million on 4 weekdays as well. So there is a rabid fan base to some of these classic movies. And we used to just say an 85-year-old Wizard of Oz was a classic movie, and now we're saying a 15-year-old stop-action or animated film is a classic movie now.
So when we talk about this idea, I mean, do you even feel the need to define it? I know there's all these purists out there. Honestly, they kind of annoy me. But, you know, I mean, I feel like we went through this with Turner Classic Movies when they started showing movies from like the 90s and the 2000s. And, of course, the same similar thing with Alamo here. Have you ever had conversations about having like a hard parameter?
Yeah, well, I will tell you some of these movies remind me how old I am, Romaine. You know, we started trying to define some of these movies, and I said, wait a minute, a 15-year-old movie is a classic movie. So we've sort of stayed away. You know, some of the older ones clearly are classics, but we've kind of stayed away from that category. And to your point, we are eventizing these movies.
How much does sort of recreations or updates of some of those old movies help your business? I mean, we kind of came in on the Beetlejuice. I don't know whether you call it a sequel or just a reimagining of it, but we're seeing a lot of these movies come down the pike now as Hollywood kind of feels like, well, if we want to get people in the theater, we just can't give them something new. We have to sort of tap in to something that's familiar, and this seems to be a formula that's working.
I think there's a lot of things that we've done a really good job of building around some of these movies. Coraline, for example, I mentioned 3D, so you have technology. We also were offering fans that came popcorn buckets and soda cups that were branded and collectibles for Coraline as well, so that helped out. With the trilogy, what we did is we offered 4DX technology, and that's the technology, if you guys aren't familiar with that blows wind and mist and different things in your face when things happen on the screen. So there are extra things happening to eventize these movies that attract audiences.
That takes me back, Ray. I mean, I'm not going to tell you how old I am, but when I was a kid, we were in Iowa City, and my mother, they had this little program with the theater downtown, Ray. You can drop your kids off so the parents can go shopping or whatever on Saturday. But they would always show these really old movies that most kids would have no familiarity with, but they would set it up with those fans and other things. So it was always exciting. I had no idea what we were actually watching, but anyway, neither here nor there. Ray, this is actually a great story, a feel-good story, and quite frankly, it gets right to my heart. Ray Nutt, he's the CEO over at Fathom Events. So are you going to go to one of these things?
I think I should. I would. I mean, I would love to see some of these on the big screen. I walked by a movie theater and the conversation was being advertised, on one of those posters, and I was like, wait a minute, with Gene Hackman from the 70s?
Yeah.
That was it?
Yeah. All right. Well, some of us like the nostalgia. Stick with us here. We're still in the moment as we set you up for some of the big market-moving events over the next week. This is Bloomberg. All right, Apple is set to unveil details of its new line of iPhones at an event on Monday. This as the company hosts a product launch event at its headquarters out there on the West Coast. Mark Gurman joining us right now to talk a little bit more about what to expect. And Mark, of course, you keep a close eye here on these Apple refreshes here. Let's start off with the iPhone, the AI-enabled iPhone, or is that going to be a misnomer?
Well, it's a misnomer in the sense that the first units that ship on September 20th won't include the new Apple Intelligence system. That's not coming until sometime in October as part of an iOS 18.1 software update. But the keynote on Monday, they're calling it Glow Time, is going to focus primarily on Apple Intelligence and the AI features that are coming to these new iPhones. Now, these new AI features are also available on existing iPads, as well as the iPhone 15 Pro and Pro Max from last year. So the AI features you'll be getting are not exclusive to this new model, but they're going to be primarily how the company markets the new devices.
What's the significance of Glow Time? Why do they pick that name?
Yeah, so there's a new interface on the iPhone 15 Pro from last year and these upcoming phones with Apple Intelligence for when you enable Siri. There's a glowing, colorful array that goes around the bezel of the phone. And so it's just an interface reference.
Okay, and of course, there's some cosmetic changes, new colors for the phone and all of that. I want to get to some of the other products that, aren't the blockbusters that the iPhone is, but are still very important in terms of hardware sales. The AirPods are going to get a refresh along with the Apple Watch.
Yeah, so you're not going to see many cosmetic changes when it comes to the new iPhones. They're going to look pretty much the same, aside from some new colors and the way the cameras look on the cheaper models. But you're going to see some interface tweaks, obviously, or some bigger tweaks, of course, to the AirPods and the Apple Watch, as you said. The mid-tier Apple Watch, the Series 10 model, that's going to get bigger screen sizes, right? Slightly bigger. You're going to see a thinner case overall, as well as some new health features. One major new health feature is sleep apnea detection. That's coming to the new watches. That's going to come to the Ultra 3 as well. And then on the AirPods, you're going to see major refreshes down the line. So the entry level and the mid-tier models, the current versions are from 2019 and 2021 respectively. Those are both going to be revamped and replaced with a pair of new fourth generation AirPods. That is going to give Apple a big boost in the earbuds market. So that's quite significant.
All right, Mark, we'll check back in with you on Monday here. Mark Gurman, who's all over this story here as we push ahead for the big potential market moving events of next week. And that includes the Apple iPhone event, which we will have full coverage of right here on Bloomberg. Also, a few other things. A milestone over at Starbucks, a new CEO.
Ryan Nickel begins, but he won't be beginning in Seattle because he's based in Newport Beach, California, and that was part of his negotiations. He can work from home.
Yeah, well, good for him there. We're also going to get a Google antitrust trial set to begin in earnings on Monday out of Rubrik and Oracle. But let's turn to Tuesday now. Of course, the headline of that day is going to be the U.S. presidential debate, the first one amongst the two, I guess we say new candidates.
Yeah, it's like a Super Bowl for the politicos, right?
Yeah.
So they're going to be all over that. That's in the evening at prime time. But before that, we do get AMD, Texas Instruments, and Intel executives to testify. So, semiconductor stocks have really been hit hard this week. We're going to see if this maybe changes the tone a little bit here.
Earnings later that day out of GameStop and Dave & Buster's. We turn to Wednesday, a big macro event here with release of the latest U.S. inflation figures.
Yeah, and right now the consensus is that the Fed is going to move forward with a rate cut, and inflation is no longer the main focus. It's really about supporting a weakening job market.
Of course, folks will parse all over that. We will have full coverage on Bloomberg Surveillance in the morning that day. On Thursday, we get a big rate decision, but not out of the Fed.
No, the European Central Bank, that's its turn to move forward with potential rate cuts, or cut, I should say. But here in the U.S., we're going to get more reads on the economy, wholesale inflation with PPI at 8:30 a.m., jobless claims as well. That's going to be more and more of a focus as we look for more up-to-date, high-frequency data points on the labor market rather than the monthly jobs report, which is backwards looking.
Absolutely. A lot of people focus on those jobs numbers here, a read on the economy. Maybe we get that out of those earnings out of Kroger, which will also be that day. Adobe also reporting, and then we turn to Friday, more economic data. And this one could be interesting, a read on consumer sentiment.
Yeah, I'm curious to see how it intersects with the changes in people's sense of what's happening in politics, because there usually is an impact there.
All right, we got a lot to cover next week. It's already been a busy week, and it's not over. Balance of Power is coming up next for all your political coverage right here on Bloomberg.